You've probably never questioned why your paycheck buys less each year, why your parents could afford a house on a single income, but you can't on two, why governments always seem to have money for wars and bailouts, but never enough for the people who actually work. The answer isn't complicated. It's just hidden, and it's been hidden the same way for thousands of years. Let me take you on a journey through time, not the history they taught you in school, but the one they deliberately left out. The story of how power protects itself by quietly draining the wealth of everyone below it. Picture ancient Rome at its height. Gleaming marble, powerful legions, an empire that seemed invincible. But by the 3rd century, the emperors had a problem. Wars were expensive. The treasury was running dry. They needed money, but raising taxes openly would spark riots. So they found another way. They took the silver coins everyone used, the denarius, and quietly reduced the silver content. At first, just a little, then more, then more. The coins looked the same. They were stamped with the same imperial seal, but year after year, they contained less actual silver and more cheap copper. The government pretended nothing had changed. Merchants had to accept the coins at face value by law. But everyone holding those coins watched their savings evaporate. Prices doubled, then tripled. A loaf of bread that cost 1 denarius now cost 10. Wages couldn't keep up. Families that had been comfortable found themselves struggling. And the government? It paid its soldiers and suppliers with the same debased coins, transferring the cost of its spending onto every citizen who held currency. This wasn't a mistake. It was policy. A deliberate transfer of wealth from the people to the state. Now jump forward to medieval Europe. Kings and queens ruled with absolute authority, but even they couldn't tax their subjects into oblivion without risking rebellion. So they invented something called forced loans. A royal messenger would arrive at a wealthy merchant's door with a polite request. The crown needs funds for a military campaign. Your contribution is required. Refuse, and you might face confiscation of property, imprisonment, or worse. Accept, and you'd receive a promissory note, a piece of paper saying the crown would repay you with interest. Sometimes they did repay years later, in coins worth far less than what you'd lent. Often they simply didn't repay at all. What could you do? Sue the king? The system was designed so that the state could access private wealth whenever it needed, without ever calling it theft. It was presented as patriotic duty, as supporting the realm, but it was extraction, pure and simple. By the time we reached the late 1600s, something fascinating happened. The tricks became institutional. In 1694, Britain established the Bank of England. On the surface, this looked like financial innovation. The government needed money to fight France. Wealthy investors would lend that money by buying government bonds. In return, they'd receive guaranteed interest payments. Where would those interest payments come from? Taxes. Not taxes on the wealthy investors, mind you. Taxes on ordinary people. Duties on everyday goods like salt, beer, cloth, candles. The working population paid higher costs on necessities so that the wealthy could earn risk-free returns on government debt. And here's the brilliant part. This system made everyone complicit. The wealthy needed the government to honor its debts, so they supported strong tax collection. The government got its funding without immediate political cost. And the public? They just saw higher prices and assumed that's how things were. Nobody explained that their taxes were literally being transferred to bondholders as profit. This model spread across Europe and eventually the world. It still exists today. Government bonds are considered the safest investment on earth. But because governments can always raise taxes or print money to pay their debts. And who pays those taxes? You do. Let's move to the modern era, because this is where it gets really sophisticated. In the 20th and 21st centuries, governments discovered they could use the complexity of the financial system itself as camouflage. Take deficit spending. Every year, many governments spend more than they collect in taxes. They make up the difference by issuing bonds, essentially IOUs to investors. Politicians tell you this borrowing is for infrastructure, for schools, for healthcare, for your benefit, and some of it is. But a huge portion flows to defense contractors, corporate subsidies, and financial institutions. When the debt grows too large, do they cut spending at the top? Rarely. Instead, they raise your taxes, cut your benefits, or inflate the currency, which silently reduces what your money can buy. The debt was created in your name, but the burden falls on you while the profits flow upward. Then came 2008, and we witnessed one of the clearest examples of this trick in modern history. Major banks had spent years making risky bets, bundling bad mortgages into securities, and gambling with borrowed money. When it all collapsed, the global financial system teetered on the edge. Governments around the world stepped in with massive bailouts. Trillions of dollars of public money went to save private banks. The message was clear: these institutions are too big to fail. But notice what happened next. Those banks didn't shrink. They didn't become safer. They grew larger and more powerful. Executives kept their bonuses. Shareholders eventually recovered. Meanwhile, millions of ordinary people lost their homes, their jobs, their savings. The gains had been privatized. The losses were socialized. You paid for the rescue through your taxes, and the banks that caused the crisis profited from it. Or consider something called quantitative easing. It sounds technical, almost boring, but it's one of the most significant wealth transfers of our time. After 2008, central banks created trillions of dollars, euros, pounds, yen out of thin air. They used this money to buy government bonds and other assets. The stated goal was to stabilize the economy, and in one sense, it worked. Asset prices soared. Stock markets hit record highs. Real estate values climbed. But who owns most stocks in real estate? The wealthy. For the average person without significant investments, the benefits were minimal. Meanwhile, the flood of new money drove up the cost of living, making housing less affordable and eroding the value of wages and savings. The trick was invisible to most people. Money creation saved the system for those who own assets, while everyone else faced higher costs and stagnant wages. Even the way governments handle retirement is a version of this con. In many countries, workers pay into state pension systems their entire lives, trusting the money will be there when they retire. But governments don't actually save that money. They spend it immediately on current expenses and replace it with a promise that future workers will pay for future retirees. It's essentially a chain letter that works as long as the population keeps growing and the economy keeps expanding. But when demographics shift, when populations age and birth rates fall, the system becomes unsustainable. What happens then? Governments reform it. They raise the retirement age. They reduce benefits. They means test eligibility. The promise you paid for your entire working life gets quietly modified, and there's nothing you can do about it because the money was never actually set aside. It was spent decades ago. This pattern appears everywhere once you start looking for it. Inflation isn't just an economic phenomenon. It's a policy choice. When governments print money or run large deficits, they know inflation will follow. They accept this because inflation reduces the real value of their debts. If the government owes $1 trillion and inflation runs at 5% per year, the real burden of that debt shrinks. But your savings shrink too. Your wages by less. You're effectively being taxed without anyone ever voting for it. The government doesn't have to announce a tax increase. They just let inflation do the work while blaming external factors like supply chains or global markets. Then there's the complexity itself. Modern tax codes run thousands of pages. Financial regulations fill entire libraries. Budget documents are incomprehensible even to experts, but partly because systems grow over time, but also because complexity serves a purpose. When you can't understand how money flows, you can't see how you're being manipulated. Defense budgets hide black projects. Social programs mask corporate subsidies. Bailout packages come with technical jargon that obscures who actually benefits. In ancient Rome, you could see the silver content of coins declining. Today, the theft is hidden in spreadsheets and algorithms. Regulatory capture is another modern version of an old game. Governments create agencies to regulate industries, supposedly to protect the public. Financial regulators, food safety agencies, environmental protection bureaus. But time and again, The largest companies in those industries end up influencing or even controlling their regulators. They hire former regulators as executives. They fund research that supports their interests. They lobby for rules that look protective but actually create barriers that keep smaller competitors out. The public sees regulation and assumes they're being protected. Insiders see opportunity. The game isn't to fight the rules. It's to right them. Even warfare has become a financial trick. During both world wars, governments issued massive amounts of bonds, telling citizens it was their patriotic duty to buy them. People believed they were supporting their country, and they were. But those bonds also became profitable investments for those who could afford them, guaranteed by future taxes that everyone would pay. In recent decades, trillions have been spent on wars in Iraq, Afghanistan, and elsewhere, almost entirely financed through debt. Who profited? Defense contractors, private security firms, banks that underwrote the bonds. Who paid? Taxpayers, for decades after the wars ended. The trick is presenting war finance as temporary emergency spending, when in reality the costs echo for generations. Here's what makes all of this so effective. Most people never connect the dots. They experience the symptoms: rising costs, stagnant wages, unaffordable housing, but they don't see the underlying mechanism. They blame immigrants, or technology, or laziness, or bad luck. They don't see the systematic transfer of wealth because it's never explained in school, never discussed in mainstream media, and deliberately obscured by complexity and technical language. Financial education isn't just helpful, it's resistance. Understanding how these systems work is the first step to protecting yourself. When you hear about stimulus packages, ask who gets the money first. When inflation rises, remember it's not random, it's policy. When regulations pass, ask who wrote them and who benefits. When governments borrow, ask who profits from the interest payments. The wealthy understand this instinctively. They hold assets that appreciate when currency devalues. Real estate, stocks, commodities, businesses. They benefit from government spending because they're positioned to capture it. They use the complexity of the system to their advantage because they can afford accountants and lawyers and advisors who understand it. Meanwhile, most people hold their wealth in currency and wages, both of which are systematically devalued by the very tricks we've been discussing. This isn't a conspiracy theory. It's just history. The same patterns repeat because they work. When a government debases its currency, citizens suffer and the state benefits. When forced loans extract private wealth, merchants lose and monarchs win. When modern states inflate and borrow, households bear the burden while financial elites grow stronger. The names change. The technology evolves. But the mechanism remains the same. Wealth flows upward and the cost flows downward. So what do you do with this knowledge? First, recognize that the system isn't designed to serve you just because it says it is. Systems serve those who control them. Second, build real wealth, assets that hold value when currency doesn't. Third, educate yourself continuously. The more you understand about money, finance, and economic history, the harder you are to manipulate. Fourth, be skeptical of official narratives. When someone tells you a policy is for your benefit, ask who benefits first and who pays the cost. The difference between financial freedom and permanent struggle often comes down to awareness. Those who understand how wealth is transferred can position themselves accordingly. Those who don't will spend their lives wondering why they work so hard but never get ahead. History doesn't repeat exactly, but it rhymes. The financial tricks that impoverished Roman citizens are the same ones draining your account today. They just come with different labels. The only question is whether you'll recognize them in time. Because once you see how the game is played, you can stop being a piece on the board and start playing for yourself. If this changed how you see the world, there's more where this came from. The truth is always waiting for those willing to look.